Hedging strategy and whole mathematics behind it. Hedging is a way of reducing the risk of unfavorable price movements in an asset. Hedging involves taking a position in a derivative, such as a future, option or swap, that is opposite to the underlying asset. By doing so, the hedger can lock in a certain price or profit margin, and protect themselves from losses if the market moves against them. One of the most common hedging strategies is using futures contracts. A futures contract is an agreement to buy or sell an asset at a specified price and date in the future. For example, a farmer who grows wheat can hedge against the risk of falling wheat prices by selling wheat futures contracts. This way, the farmer can guarantee a certain price for their crop, regardless of what happens in the spot market. The mathematics behind hedging with futures involves calculating the optimal number of contracts to hedge, the hedge ratio, and the hedge effectiveness. The hedge ratio is the ratio of the size of the position in the futures contract to the size of the exposure in the underlying asset. The hedge ratio depends on the correlation and volatility of the futures and spot prices, as well as the risk preferences of the hedger. The hedge effectiveness is a measure of how well the hedging strategy reduces the variance or risk of the portfolio. To illustrate, let's consider an example of hedging with futures. Suppose a company expects to buy 1,000 barrels of oil in 3 months, and wants to hedge against the risk of rising oil prices. The current spot price of oil is $50 per barrel, and the 3-month futures price is $52 per barrel. The company decides to use a hedge ratio of 0.8, meaning that it will buy 0.8 futures contracts for every barrel of oil it expects to buy in the spot market. Therefore, the company buys 800 futures contracts at $52 per barrel. 3 months later, suppose the spot price of oil has risen to $60 per barrel, and the futures price has also risen to $62 per barrel. The company has to buy 1,000 barrels of oil in the spot market, paying $60,000. However, it also makes a profit of $8,000 from selling its 800 futures contracts at $62 per barrel. Therefore, its net cost of buying oil is $52,000, which is equal to its expected cost when it entered into the hedge. The hedge effectiveness can be calculated as follows. E equals 1. Variance of hedged portfolio, variance of unhedged portfolio. The variance of the unhedged portfolio is the variance of the spot price changes over the hedging period. The variance of the hedged portfolio is the variance of the changes in the value of both the spot and futures positions over the hedging period. In this example, suppose that the standard deviation of the spot price changes is $5 per barrel, and the standard deviation of the futures price changes is $4 per barrel. The correlation between the spot and futures price changes is 0.9. The variance of the unhedged portfolio is VU equals 5 squared equals 25. The variance of the hedged portfolio is VH equals 10.8 squared 5 squared plus 0.8 squared 4 squared 2 asterisk 10.8 asterisk 0.8 asterisk 5 asterisk 4 asterisk 0.9. VH equals 1.44. The hedge effectiveness is E equals 44/25 equals 0.942. This means that hedging with futures reduces the risk of buying oil by 94.2%. Thanks for watching. If you enjoyed this video, please hit the like button and subscribe to my channel for more content like this. Until next time, happy trading!